All right, let's get into it. This is the ultimate showdown for pretty much every millennial investor out there: index funds versus ETFs. Today, we're going to settle this debate once and for all and figure out which one really truly belongs in your portfolio. So what if I told you that just picking the wrong one of these could cost you over $73,000 during your investing career? And no, that's not some made-up number. It's a very real possibility when you factor in all the hidden fees and, our own behavioral mistakes. So the big question we've got to answer today is this: are you making this mistake right now? We're going to figure that out using the latest data to see which one of these is actually the right tool for your specific situation.
Okay, first things first. You need to understand that these two are basically financial twins. Seriously. Both an index fund and an ETF can track the exact same thing, like the S&P 500. So they hold the same stocks, but their personalities, how they actually work, are completely different. And here's where those personalities really start to show. An ETF, it trades just like a stock, all day long. You can buy it, you can sell it, anytime the market is open. But an index fund, nope. It only trades once per day after the market closes. Index funds also tend to have higher minimum investments, but they make automatic investing super easy, which is something most brokers just don't offer for ETFs. Now here's what's really wild. About 93% of millennials don't even realize that the very same fund can exist in both of these forms. I mean, take Vanguard's S&P 500 fund. You can buy it as VFIAX, which is the mutual fund, or you can buy it as VOO, the ETF. You are literally getting the exact same underlying investments, but the wrapper and your entire experience with it is totally different. Okay, so let's keep going, because now it's time to talk about the real costs. It is so easy to just get hung up on the expense ratio, but trust me, that is just the tip of the iceberg.
At first glance, this difference looks ridiculously tiny, right? Vanguard's mutual fund, VFIAX, has an expense ratio of 0.04%. The ETF version, VOO, is just a hair cheaper at 0.03%. We're talking about a difference of 1/100%. I mean, who cares? Well, you should.
Because that tiny 0.01% difference, if you take an initial $10,000 investment and let it grow for 30 years, is going to cost you $1,800. Poof, gone. That's a vacation, a new laptop, or a serious chunk of change for your retirement. Just lost to a fee that seemed completely insignificant. See, compounding works on costs too.
But it gets way more complex. ETFs have all these other little costs, like the bid-ask spread. That's the tiny gap between the buying and selling price, and you pay it on every single trade. Meanwhile, index funds might hit you with redemption fees if you sell too soon. For someone who trades a lot, those little ETF costs could easily add up to that shocking $73,000 figure over time. But for a passive investor, the slightly higher mutual fund fees could just be quietly eating away at your returns. And now, we have arrived at what is without a doubt the single most important factor in this entire debate, especially if you are investing outside of a retirement account. I am talking about taxes.
And I am not exaggerating when I say this. When it comes to your regular taxable brokerage account, the way ETFs are built gives them an advantage that is a complete and total game changer. It can literally save you tens of thousands of dollars.
So here's why. Mutual funds, by law, have to pass along any capital gains they make during the year to all of their shareholders. This is called a capital gains distribution, and guess what? It's a taxable event for you, even if you never sold a single share yourself. It is, basically, a surprise tax bomb.
And these can be huge. Just look at this real example from 2024. The Vanguard Target Retirement 2050 Fund, a super popular choice, handed out a massive 11.3% in capital gains. So if you had $100,000 in that fund, you got slammed with an unexpected tax bill on over $11,000 of income you didn't even realize you had. So the bottom line is this: a typical millennial investor could be facing an unexpected annual tax bill of, say, $600 to $1,200 just for holding a mutual fund. And with an ETF, zero, zilch, nada. Because of how they're structured, ETFs can basically swap stocks around without actually selling them for cash, which means they don't trigger those capital gains for you. You get to control when you pay your taxes. Okay, so all the math seems to be screaming ETFs, right? Well, not so fast, because none of the numbers matter if your own behavior gets in the way. The best investment is never the one with the lowest fees. It's the one you can actually stick with for the long haul. This is where you have to be really honest with yourself. If you're the kind of person who just wants to set it and forget it with automatic contributions every paycheck, index funds are your absolute best friend. But if you're just getting started and have less than $1,000, being able to buy just one single share of an ETF is a massive advantage.
So which group actually does better in the real world? Well, a major study from Fidelity on millennial investors uncovered a pretty shocking performance gap between the two.
That's right. The boring investors, the ones who just use simple index funds, actually had 18% higher returns. So why? Well, the study also found that ETF investors traded 3.2 times more often. The fact that you can trade an ETF all day long makes it way too tempting to try and time the market or to panic sell when things get rocky. That once-a-day trading of an index fund, it's not a bug, it's a feature. It literally saves you from yourself.
So, where does all this leave us? It means you should stop trying to pick a winner. The smartest strategy isn't about choosing one over the other. It's about using both of them, strategically, in the right accounts.
So here it is. This is the optimal framework. In your 401k, you use index funds. They're perfect for automatic disciplined contributions. In a Roth IRA, ETFs are great because you can start with just a little bit of money, and hey, taxes aren't an issue anyway. And in your taxable brokerage account, it has to be ETFs. You gotta avoid those surprise tax bombs. And your emergency fund, of course, that should be in a safe, high-yield money market fund.
Look, both of these are incredible tools for building wealth. The real mistake, the only mistake, is not investing at all. But now you know exactly which tool to use and when, which is going to make your journey a whole lot smoother and way more profitable. So what's your strategy now? Are you team index fund, team ETF, or are you going to start playing both sides like a true financial pro?